The Federal Reserve raised rates by 75 basis points today, and the markets reacted very positively. We're going to be talking about why, and we're talking about exactly what investors can do right now that stocks are down on the year, but perhaps we're due for a recovery. Let's see. We're here to discuss this with our next guest, John Cochrane. He is a senior fellow at the Hoover Institute at Stanford University, and he was formerly the professor of economics at the University of Chicago. He is also the writer of a blog called The Grumpy Economist, and he has a new book coming out this fall entitled Fiscal Theory at the Price Level. We'll be talking a little bit about that and how that applies to asset pricing today. Welcome to the show, John. It's a pleasure to host you here on Kitco.
Pleasure to be here.
John, let's talk about the Fed's action today and market reaction, and then we'll get into the economy at large. As I said in the beginning, 75 basis point rate hike. The markets reacted very positively. While the stocks, the equity markets were up on the day by a lot. They were up actually at market open, but then climbed dramatically at 2 o'clock right after their decision to raise rates. Now, John, I wonder if 75 basis points is interpreted as dovish. What do you think?
Well, I guess that's how the markets are interpreting it because they're back up. But who knows? I mean, what we do know, I'll tell you what I think about. This is all about where does this keep going, and the markets seem to think we got maybe one or two more and then we're done. Good luck to them. I think the Fed's going to keep raising interest rates as long as inflation stays high. So the big bet is: do you think inflation is going to largely come down on its own, or is it going to wait until interest rates get substantially above inflation to put them down?
Now, what is your view on the relationship between interest rates and inflation right now? There is a prevalent view among some economists that have been on the show that even what the Fed is doing right now is not enough to combat inflation. What do you think?
That is the sort of consensus view, and it's remarkable how consensus economists differ from the markets here. The consensus view, including my colleague John Taylor and Larry Summers and everyone in between, is that you don't bring inflation down until interest rates are substantially above inflation. That means right now with 9% interest rates, economists are talking about 10, 11, 12%, 9% inflation. Economists are talking about 10, 11, 12% interest rates to bring them down. That's huge. We're not even close to that. Now, I think the Fed and the markets are counting on a lot of inflation going away on its own without interest rates having to go quite that high. And we'll see a big test of ideas about which one turns out to be true.
And so I'm assuming you're suggesting that the Federal Reserve is aiming for a soft landing then, that assuming that they have some smart people working at the central bank and they understand what you're saying, the question is, why aren't they raising rates to above 9% CPI? What's stopping them from doing that?
Oh, nothing's stopping them except the fear that doing that would cause a absolutely massive recession that would cause all sorts of havoc. The Fed's always aiming for a soft landing. The question is, how much fog is there in the windshield? And it's not about being smart. It's, there's actually uncertainty about just how hard the Fed has to raise interest rates in order to get inflation to go down. This is one of these things that we really don't know as well as we wish we did.
Do you think there's political pressure from the White House to keep rates low?
Oh, absolutely. As there, and this is not partisan. Trump was banging on his fists on the table about keeping interest rates low, especially with elections looming. Politicians always want to keep interest rates low. They don't want a little bit more inflation is much less of a worry for them than or the kind of recession that would come from sharp interest rate rises.
It's interesting. Actually, last week the White House issued a blog criticizing the NBER, the National Bureau of Economic Analysis. It's interesting how the White House is critiquing another government agency, but they were basically questioning whether or not the calculations for economic decline are correct. They were questioning whether or not we're even in a recession or that second quarter GDP should be in a decline. Yeah.
Let me check on the facts on that one. The White House was actually endorsing the National Bureau of Economic Research's methodology, which does not proclaim a recession automatically from 2 quarters of GDP growth decline, but it in fact does. The NBER has a holistic approach, looking at lots and lots of numbers to declare when a recession has happened. And usually they don't do that until much afterwards. They tell you a recession had happened. They're really in the business of economic history. So that one was technically correct.
Okay, so they're endorsing them. That wasn't
Well, it depends what
Well,
you mean by recession. So this is one of these loosey-goosey terms that isn't really defined that carefully. We all kind of know it when we see it, but is it really GDP going down? Is it unemployment going up? Is
right.
it industrial production going down? Who knows? And the NBR kind of looks at all the numbers a year later and says, "Oh yeah, we were in a recession a year ago," but after looking at all the numbers, it's kind of, the word isn't that meaningful. What we do know is that it looks like we're going to have 2 quarters of a slightly negative GDP growth. So that's a fact, whether you want to put recession holy water on it or not.
Well, Biden has told reporters earlier, I think on Monday, that he doesn't see us going into a recession. He cited the strong unemployment with the strong labor market as one reason. The unemployment rate, he said, is still at multi-year lows, around 3 to 4%.
Yeah,
so,
we're in this really weird labor market. So the unemployment rate is really low and job vacancies are just huge. This is, employers are finding it really difficult to get people to take jobs. On the other hand, it's kind of puzzling how many people are not even looking for jobs. They're still kind of sitting around enjoying themselves or doing whatever they're doing. And it's very difficult to run a business right now. Lots of people are still going out with COVID. There's still all sorts of supply chain problems. So it's kind of a weird economy more than a really strong economy.
Okay. So, John, people are wondering, the average American is wondering, what can be done now by policymakers to fight inflation? If not for monetary policy, then what else?
Yeah, so we have, I think, put too much faith in the Fed will cure all of our problems with interest rates. This inflation clearly came not from monetary policy, not from interest rates, but the government printed up about $5 trillion of money and handed it out as checks. Now, a lot of that was important. A lot of people were really hurt in the pandemic. A lot of people got checks and weren't really hurt in the pandemic. And they wildly overdid it. You spread around $5 trillion of money, you're going to get inflation. So that wasn't the Fed. We're asking now the Fed to put that back in a bottle a little bit. But really, curing inflation doesn't just come from the Fed. You've got to cure all the sand in the gears of the rest of the economy, get fiscal policy back on track, just sort of start trying to run the economy the way normal countries run economies without all the spin and excuses and other stuff that goes on.
How much of the price increases in the CPI can be attributed to the war in Ukraine? I believe Biden has called the current inflationary environment Putin hikes, or Putin
Putin's
price hikes.
Hike with capital letters. That was one of their attempts at spin. It didn't actually catch on because nobody who wasn't actually on the payroll of the White House ever used that ridiculous term. This is part of the kidding yourself. For a year now, we have heard that inflation doesn't come from monetary and fiscal policy. It comes from the great chicken conspiracy to raise the price of chickens, or Putin's price hike, or the dog ate my homework. I think kind of the nadir of all of this was when Biden himself went out and said gas stations should lower the price of gas, which is just silly as far as where inflation comes from. There's only so much gas to go around. If they actually lowered the price of gas, all you get is gas lines because more people want it than is there. This is just, there's been a year of not serious economic policy dealing with inflation, and that's part of it. The war in Ukraine actually, I don't think is that, first of all, the inflation was going nice and strong for a whole year before the war in Ukraine came out. There's some worries in the energy markets, but that's largely one price going up relative to another. You got to remember, inflation is when everything goes up. If there's problems with oil, yeah, oil prices goes up. If there's a problem with gold prices go up relative to other things. But everything goes up at the same time. That's always monetary and fiscal policy.
Well, if you look at the latest CPI numbers, and you break that down, energy, gasoline, fuel, for example, was the component that went up the most. Some would argue that if energy prices go down, well, first of all, by I guess mathematical technical definition, the CPI basket would go down. But how much of the economy is based on oil? Suppose you have oil go up, wouldn't it make sense? Wouldn't in theory it make sense that businesses' fixed costs would also go up? Hence, their prices need to go up to keep their margins up. Isn't oil the basis of everything that runs here?
Oil is not actually.
Okay.
So the 1970s, we had these famous oil price shocks that spread a lot of inflation around, but we've become much more energy efficient. So it is true that when oil goes up or comes down, anything that needs to go by a truck is that much more expensive and so forth. But oil is actually, I don't have the numbers handy, oil and the energy intensity of things is not as high as commonly thought. And a lot of this is still, it's not supply of oil, it's the demand for oil. The price of oil wouldn't be high if we weren't all trying to go out and drive around.
Well, okay. Well, that's a different discussion because I think electric vehicles are supposed to solve that problem, but
not in your lifetime.
Not in your. Okay. Well, let's talk about that briefly. I mean, the Biden administration has aimed to, I believe, cut greenhouse emissions down to zero by 2050, and they want all vehicles on the road to be electric by 2035. After the U.S. is not the only jurisdiction in the world to have that policy. Yeah. The UK and Canada, where I live as well, banning petrol vehicles by 2035, and you're saying it's not going to happen within our lifetimes.
Well, they may do that and hang on to your gas-powered car and hang on to your horse cart because you may be needing it. Now, the ban is on all new ones. There's this little bit of a problem. How do you build batteries for all those new cars? And there's another as far as the climate's concerned, there's another problem. China is building a new coal-fired power plant every week. So, anything we do about that is at best going to change the world temperature 1/10 of a degree in the year 2100, but is not going to do anything about the wildfires in California or the heat in Canada and within our lifetimes.
It may or may not increase or enhance energy independence for any country, right? We don't have to depend on OPEC for oil. The Europeans don't have to depend on the Russians for oil.
But still, you look at the numbers of how much energy you actually save from electrifying cars. Remember, you got to produce the electricity somehow.
Sure.
And if you don't allow nuclear plants and you don't allow geothermal and you don't allow you're going to do it all from windmills and solar panels, also imported from China. Good luck to you. So just buying the electric car after you use all the energy to make the huge batteries in it doesn't do an immense amount. You want energy independence, allow fracking and get the natural gas through pipelines. That's what made energy independence in the U.S. In the last 10 years. The U.S., by the way, lowered its carbon emissions more than any other country. Why? Nobody's policy. Fracking and natural gas is what did it, which emits about half as much as coal and other fossil fuels.
Going back to inflation now, John, Biden's multi-billion-dollar infrastructure plan, part of which encompasses building infrastructure for green energy, he says that it's supposed to be long-term deflationary, or at least it wouldn't increase inflation. In fact, I think he said a few months ago he had 17 Nobel Prize laureates sign a letter saying that this would not increase inflation. Is he right?
Don't they look a little bit silly now that inflation's 9%? But there is an argument that a little better infrastructure, better infrastructure makes stuff cheaper. That really has nothing to do with inflation. That could mean that prices go down and wages go down a little bit less. That's, but it makes us all better off. So a little better infrastructure is good. Unfortunately, most of what went into that is not infrastructure. We only got about $100 billion out of infrastructure. Then the Federal Highway Administration issued a decree that they are not going to use a single cent of that to build anything that involves new highways, no new road beds, no new lanes that might be used by single family cars. So good luck to you getting a lot of productivity increase out of that kind of infrastructure. There's just a lot of pork in it.
John, suppose the Federal Reserve didn't do anything at all. Let's suppose they didn't raise interest rates today or ever again. Would inflation just fix itself eventually? Would prices fall to equilibrium by themselves?
That is a fascinating question. I think there is actually more chance of that than is commonly acknowledged. Not prices, but inflation. What could happen is the Fed doesn't do anything. We do get inflation. The Fed printed up all this money and handed it out. So you get a substantial inflation, but it eventually slows down on its own. And what's the evidence for that? The evidence is the whole zero bound period, where interest rates just stuck at zero forever and ever, and inflation never went anywhere. The contrary view is that if the Fed does nothing, inflation will spiral away and get worse and worse and worse. That's sort of the conventional view. And let's fight it out and see which happens. But it's not impossible that your first view is true, that if the Fed is slow to act, inflation does eventually come back, it does eventually work itself out if we don't get bad shocks along the way. This is all conditional on people are happy buying the new government debt, the economy recovers, the supply side is good, there aren't any more wars or pandemics or other stuff coming along. So that's possible, but I'm also worried about the risks. The main thing I worry about is the risks of new shocks coming to get us.
Okay, can you comment on what these shocks potentially could be?
Bad stuff's going to happen. It is just a fact of life. Bad stuff's going to happen. And to your investment questions, risk management and can you take the risk is the first question in life. But as we were making beautiful forecasts about no inflation being there forever, and climate change being the greatest problem civilization faces, and then boom, we got a pandemic that nobody was expecting, not even the Fed or anybody's stress tests or anything. So, bad stuff's going to happen. This war could get worse. China could invade Taiwan. A new pandemic could come out. The Middle East could blow up. Iran seems to think it's going to have a nuclear bomb one of these days. Some shock is going to happen. China is the Chinese financial situation looks to me like that could be the next 2007. So some bad's going to happen. I don't know what it is or where it's going to be, but that's the fact of life.
The WHO
monkeypox.
Monkeypox is a global emergency. No one seems to be talking about it here in the U.S. But
there's plenty of talk about monkeypox in the U.S. too. And,
is there? Okay.
Here we go again. The CDC and FDA are way behind the curve in getting vaccines out.
All right. Well, it certainly hasn't made it to my group chats with my friends yet. Maybe people here are just a little bit behind on the curve. But okay, let's talk about some theoretical, concepts or ways we could combat inflation. You've written about the gold standard before. You've written op-eds about it. What is your opinion on the gold standard? Are they effective tools for controlling inflation?
Sorry, no. Well, they are. The gold standard was for centuries an effective tool at controlling very long-run inflation. So the price level, the overall level of prices was the same for centuries under the gold standard. There was a lot of inflation and deflation. 10 or 20% up and downs of inflation and deflation. But every inflation was then matched by a deflation. But the gold standard is not a way you can run a modern economy. For one thing, for that big up and down of inflation and deflation. So it's all right, we're not going back to gold. Although it had some advantages. And I think, someday our grandchildren maybe can put some of the good parts of the gold standard into our monetary policies.
It does. It's interesting to observe that during the Bretton Woods era, in the 40s all the way up until 1971, inflation in the U.S. was relatively low compared to the average rate of inflation post 1971. Right? Can that be attributed to the Bretton Woods system?
In part, or the remaining. So the gold standard, I'm thinking from 1800, from 1800 until 1933, there was essentially no overall inflation, though lots of ups and downs. There's a lot of nostalgia for Bretton Woods. Bretton Woods is awful. Bretton Woods was a system where the U.S. was on gold relative. The dollar was relative to gold for foreign central banks. Currencies were pegged. You and I were not allowed to own stocks and bonds internationally. International capital markets were closed. Very difficult international trade. I was young enough. We went to Europe as a kid. It was very hard to get enough cash out of the country in order to go to Europe for more than a week or so. So it was a terrible system, and it blew up in the 1970s because under Bretton Woods, you cannot finance substantial deficits or substantial trade deficits. So our modern world of open capital markets, trade deficits and surpluses, government debts that rise hopefully for good spending and maybe for not so good spending, all of that was impossible under Bretton Woods. It blew up. It was bound to blow up, and good riddance.
What about using digital currency as a global reserve currency, like Bitcoin, like a Bitcoin standard? Would that solve a lot of our monetary troubles?
There's a terrible idea. Bitcoin is very interesting technologically, but it hasn't come up with anything new in terms of financial technology. Bitcoin is an attempt to revive gold, something intrinsically worthless that people only hold on to because it's rare and somewhat useful in transactions, especially avoiding taxes and sanctions and other problems. You can see from the volatility of Bitcoin. So if we quoted everything in Bitcoin, then Bitcoin would be stable and the price of everything else would go up and down like crazy, just like it did under the gold standard. Bitcoin's also very poor for making transactions itself, since it's so computationally intensive. So sorry, that's not the answer. The best answer is our governments should start running sober fiscal and monetary policies, pay more attention to keep inflation under control. And we had a pretty good system going of low inflation and well-run countries. And we need to get back to that rather than try to invent something totally new.
Well, just a few more questions on this and we'll finish up on asset pricing. Now, Fiscal Theory of the Price Level, this is your book coming out in the fall. Let's talk about some of the fiscal policies that you're talking about in this book that's coming out. I've actually got one for you to comment on, and then we'll get into your book. Supply-side economists like Arthur Laffer have suggested that reducing taxes could actually reduce inflation through incentivizing increased production. You have more supply, hence the fall of prices. Is that something that is observable in the real world?
Yes. Now let's be a little bit careful. Only economists are going to talk this way, but you're going to hate me, but it's true. You need to reduce tax rates, not reduce taxes, and that's the art.
Okay.
Because what is key in Laffer's thinking, and he's absolutely right, is that if you earn an extra $1, but you have to pay 70 cents of it to the government, you don't have much incentive to earn that extra $1. And the same goes for companies and stuff. That's the marginal tax rate. That's the thing that's got to come down. Taxes have to go up because our government needs to spend money and needs to pay back its debts. How do you get taxes to go up while tax rates to come down? Well, you broaden the base, you simplify the tax code, and you encourage economic growth, because what really is important is the ability to pay back your debt. That's over 10, 20 years. That's not tomorrow's deficit. That's not austerity. That's not in one life of one politician. And that's where the magic comes in. If you can reduce marginal tax rates, reduce regulations that aren't working, get the sand out of the gears, the economy grows. And then you got more GDP, the same tax rate times the more GDP, and the government's rolling in money in order to squelch inflation and do all the great things it wants to, like subsidize your electric cars, maybe.
Mm-hmm. If your tax rate goes down for not just corporations, but for the consumer as well, wouldn't your discretionary income by definition goes up, wouldn't you be more incentivized to spend, assuming your savings rate doesn't go up? Wouldn't you actually want to spend more money, and wouldn't that actually push prices up, assuming everything else being equal?
My, how things changed. Wasn't it only last year we wanted people to have more money to spend in order to raise demand and get things going? Look, over the long run, what really matters is this is what we're discovering. This is actually a beautiful moment. The current chaos is a beautiful moment. All of these progressive dreams ran into the brick wall of supply. We have just found out that our economies are limited in the amount of stuff they can produce. And why are they limited? Well, there's all sorts of stuff we'd like to do, but you just can't get the permits. We're also limited by the difficulties of the labor markets and labor laws and so forth. But right now, it's abundantly clear to get the economy going, you need better incentives, better ability to run businesses, better ability to hire people to get more flexible economies going. That's the supply side challenge. And that's the challenge for our time as soon as we wake up and face that that's the fact.
So your book that's coming out to be published by the Princeton University Press, do you talk about ideal fiscal policies that could both potentially help fight inflation but also incentivize growth? Is there an optimal balance here?
I don't talk about it that much in the book, but yes, and it's fairly straightforward. What you want is lower marginal rates, a much broader base, less loopholes and exclusions, and a whole lot less complication. So the ideal tax is in some sense just a pure value added tax, and do all, if you want to redistribute money, fine, send people checks, but keep the tax code really simple and oriented towards economic growth, as opposed to hundreds of thousands of pages and oriented to subsidizing this, that, and the other thing.
Okay. Can you give us a synopsis of some of the some of your findings that you've done in the research in the book?
Yeah, this is about how does fiscal policy affect inflation? And I think we're seeing that right now. Again, this inflation pretty clearly comes from the fact that the government gave everybody checks. That's fiscal policy. That's transfers to people. You can see how big budget deficits that people don't trust are going to get repaid by future debt leads to inflation that then at best you're asking our central banks to contain, but it's not just from the central banks. And the central banks, I feel bad for them. They're kind of in the situation, you're in a car with someone and they've got their foot on the gas pedal, and what you can do is maybe pull the handbrake, but a car where the gas pedal is still floored and you're trying to pull the handbrake isn't a very healthy situation going forward. It'd be far better to cure the underlying fiscal problems and get the foot off the gas pedal.
That's a very interesting perspective that the fiscal policy was the cause of inflation. Some monetarists would argue, if Milton Friedman were alive today, he might argue that inflation was caused solely by the expansion of the money supply. And indeed, we've had a more than 40% increase in M2 over the last 2 years. Was that the cause of inflation?
I don't think so. But that's one you can argue. Now, this is the one time it's worked in the last 40 years.
Okay.
They've been watching M2. Remember when our central banks did quantitative easing and pumped trillions of dollars into the economy, and what happened? Nothing. Silence. So there's a danger of being the guy with the sign saying the world is ending, and finally you're right at one point. But to this question, suppose that rather than, so why do we have so much M2? Because the government sent us all checks and we left it in bank accounts. That's why M2 went up. Suppose that the government had sent you shares in a mutual fund that held treasury securities rather than sending you checks in a bank account. Would that have made any difference? People look and say, oh, wow, I got this mutual fund, honey, it's worth $20,000. Let's go spend stuff. Wouldn't that have been exactly the same as, oh, I have a bank account that has $20,000. Let's go spend stuff. Well, if you're monetarist, that's all the difference. The mutual fund holding treasuries wouldn't do anything, but that's obviously not true. Or conversely, suppose there hadn't been any deficits at all. Suppose that the government had simply raised taxes to give people that increase in M2. Maybe we wouldn't be getting inflation at all now. So the monetarist position is it's about money relative to bonds, not about the overall amount that they sent us. I think it's pretty obvious. It's the overall amount that they sent us. Whether they sent us 2 5s and a 10 or $20 bills doesn't really matter. What matters is how much they sent us.
All right. We'll save that debate for another day. I want to close off on. I want to close off on asset pricing. You are an expert on asset pricing, and we'll talk about some of the models you use. Do you think the stock markets, the public equities markets, are fairly valued today?
Yes. No, I have to say that because I've been an efficient market type for 50 years now, and the market is, as always, balanced where exactly half of the people think it's overvalued and half of the people think it's undervalued. And if anyone tells you they know better, ask them so why aren't they rich? And they may be rich just because they got really lucky. Why aren't they consistently? It's very, very hard to consistently beat the market. And academic studies, nobody can really do that. So the market, if you're going to say it's undervalued, you have to explain to me why you're right and the other half of the people are wrong. And by the way, they think they're right and you're wrong, and maybe look in the mirror and worry about it. The way to think about market valuations right now, the primary thing going on is the effect of higher interest rates. Why have markets gone down? Fairly clearly, not so much because people see a horrible economic situation in the future, but because the alternative, you see higher interest rates. Higher interest rates is a discount rate. The expected rate of return goes up. That always makes stock prices go down. Right. So I think mostly what you're seeing now and up and down the stock market is guesses about where the alternative asset real interest rates are going. And there it's anybody's bet. So the one nice thing I'll say is that over the long run, these kinds of fluctuations do even out. So a fluctuation in the stock market because the economy tanks, that's kind of forever. But if the stock market goes down because interest rates go up, well, when interest rates come back down again, the stock market will go back up again. So if you're holding for the long run, it's a lot less risky than you thought. Have I managed to avoid your question carefully enough?
Let me be a little more direct. An investor watching might say, John, is the stock market going to go up or down by the end of the year? Now, an investor needs to take a position. Yes. An investor cannot tell an investor cannot tell his clients, I believe, an institutional fund manager cannot tell his clients, I believe the markets are fairly valued, because that implies you're going to do nothing. You have to take a position. You have to either think it's undervalued or overvalued and allocate your assets accordingly. So could you pick a side right now, John?
No. The average investor has to hold the market. That's just a fact. So if you do one thing, then beyond that, it's a zero-sum game. So if you think you're an overweight, then you're betting that you're the right and somebody else has to underweight and they're wrong. And they think you're the moron who is behavioral or stupid and they're smarter than you are. Mm-hmm. So you got to be smarter than the average person to take any bet whatsoever. That's very difficult to do. And, investment advisors seem to think they need to proclaim, and that's in order to justify charging a lot of fees. Well, maybe you shouldn't be paying so many fees.
All right. That's another debate for another time. John, final question, I'll let you go. What is your outlook, then? I haven't had a chance to ask you. What is your outlook on economic growth? We've talked about, the prospect of a recession. Should it come? Should we already be in a recession? How severe is it? How long is it going to last? Do you have any ideas?
No, but neither does, I can tell you with great certainty, neither does anyone else either. I do think there's a chance. So let's look at history. We are in a chance of repeating the 1970s. So let's reiterate that sort of conventional view. The Fed's behind the curve, way behind the curve. If we are repeating the 1970s, the Fed will chase inflation up to the point that it creates a recession. The recession will be fairly severe. The Fed will then give up too soon and we'll get another bout of inflation or recession. That's a scenario. And your investors should think about risk scenarios before they think about what thing they're going to jump on. That's a scenario that I think is a genuine worry. The other scenario that's a genuine worry is that something bad happens, that we get hit by another shock, the war gets bigger, China invades Taiwan, China's property situation booms. So that could also send us into a recession. Over the long term, which is really what we should be talking about, there is this overhanging fact that economic growth slowed down dramatically starting in the year 2000 in the US and has never really recovered. And the US is doing better than anyone else in the world. Economic growth in Canada is even slower. Italy is now at the same place it was in 2009. It has not grown at all since 2009. Most of Europe is growing half as fast as the United States. Long run growth is this sort of steady cancer in our economic system. This is not about a recession. This is just about growing at 2% a year rather than 4% a year for the rest of our lifetimes, which means your kids are going to be half as well off as they should be. That's where, and then that's all supply side. You're seeing it right now, how difficult it is to grow the economy's productive capacity.
Sorry, I promised I'd let you go. Last question, I promise. There's so many fascinating topics you're bringing up. Why is it that the Fed has a 2% inflation target? Why not, in theory, target 0% or even deflation? I mean, the average person is probably asking himself, wouldn't my living standards increase if prices go down every year?
Yeah, well, not if the wages go down faster.
Okay.
Again, you got to remember, so everyone confuses relative prices with inflation. Inflation is the amount by which prices of everything and wages goes up or down every year. But why should that be 2%? In the US, the Fed's mandate is, quote, price stability. Now, when they wrote price stability, I don't think they had in mind 2% inflation forever and ever. Somehow the Fed rewrote that in their minds to mean 2% inflation forever and ever, which I don't know where they historically, I'll give you a long lecture someday on where that came from. And other central banks just kind of picked two out of thin air. Why should the price level go up 2% a year, every year, forever and ever? Now, the answer is what the Fed says is they want 2% inflation so that interest rates can be about 3%, so that when there's a recession, they can lower those interest rates to zero in order to help us out. It's sort of like the theory of wear shoes that are too tight all day because it feels so good when you take them off in the evening. I'm profoundly skeptical of that. As I'm profoundly skeptical of the idea comes down to that a zero interest rate is a terrible thing threatening deflation. Well, we had those for 10 years. Japan had them for 30 years. We never saw any horrible thing coming out of those. So that's the reason. They want to buy themselves some headroom in order to stimulate in recessions. How important is that? How useful is that? I'm dubious. And the advantages of what we had, the one good thing about the gold standard era, knowing that over decades, there would be overall no inflation, that if you bought a 30-year bond in 30 years, that principal payment would be worth the same $100 as now. There are some substantial advantages to no inflation over long periods. Maybe someday we'll get back to that.
Well, John, I'll let you go. I promised that would be the last question, but I hope I have all day to talk to you. I personally learned a lot in the last 30 minutes, so thank you for your time.
Thanks. It's been fun. Good questions.
And I'll look forward to speaking with you again. I hope to have you back on the show. And thank you for watching Kitco News. I'm David Lin.